Hey guys, welcome back to the channel. In today's video, I'll be talking about return on equity. Return on equity is one of the financial ratios that investors can use when investing in the stock markets. In this return on equity for beginners explained video, I'll be going through a couple of things. Firstly, what is return on equity? Secondly, how to calculate the return on equity? And thirdly, how to use return on equity in the markets. If you are interested in all of that, stick around in this video. Alright, let's dive right in. So the first thing that we'll take a look at is what is return on equity. So what a return on equity ratio does is it measures the profitability of a company in relation to its equity. And in other words, the return on equity measures how effective the company is able to use its assets to generate profits. Let's take a look at an example to see what this means. In this example, we have two companies, Company A and Company B. Say Company A has net profits of $100 million and Company B has net profits of $50 million. If we were just to take a look at absolute numbers, we would say that Company A is doing relatively better than Company B. Because Company A has a higher net profit compared to Company B, 100 million compared to 50 million. But that doesn't give us a full picture. If we want to find out the effectiveness of the management of the two companies, we need to dive deeper, beyond just the absolute numbers. Now, on top of just taking a look at the absolute profit numbers, we now have some numbers on the equity of these two companies. And Company A has an equity of $75 million and Company B has an equity of $25 million. With the additional data, we now can take a look at the effectiveness of management of these two companies. And if we were to calculate the return on equity or ROE of these companies, Companies A ROE will be 1.33 and Companies B ROE will be 2. So based on the return on equity ratio, we see that even though Company B has a lower absolute profit figure compared to Company A, Company B has actually a higher ROE or return on equity. This means that Company B is more effective in using its equity to generate profits. So what the return on equity ratio helps us as investors in the stock market is to look beyond just the absolute profit numbers of a company and to look at actually how well the company is using its equity to generate profit. And that is what the return on equity ratio helps us in. The next question that you might have is, now that we know what the return on equity is, how do we calculate the return on equity ratio? And that is what we'll take a look at next. The return on equity formula is taking the company's net income divided by its shareholders' equity or net assets. So how do we find the net income of a company and its shareholders' equity? We do that by taking a look at the company's financial statements. If you have enjoyed and learned something from this video so far, smash that like button because it will really help this channel grow and allow me to produce more content such as this. Alright, let's get back to the video. To calculate a company's shareholders' equity, we take the company's total assets minus its total liabilities. And that is why shareholders' equity is also known as net assets. And we can find the company's assets and liabilities under its balance sheet. Let's take a look at an example of a company's balance sheet. This is how a company's balance sheet looks like. At the top, we have the company's total assets. And in this example, we see that the company's total assets is 301,311. And further down, we have the company's total liabilities. The company's total liabilities is 183,007. And at the bottom, we see that the company's total equity is 118,304. So how do we calculate the total equity of a company? As you have seen in the previous slide, to calculate the total equity of a company, we take the company's total assets minus its total liabilities. In this case, it will be 301,311, which is its total assets, minus 183,007, which is its total liabilities. And we'll get a net sum of 118,304. And that is how we derive the shareholders' equity of a company. To recap, to find a company's shareholders' equity, we first have to take a look at the company's balance sheet. And on the balance sheet, we want to look out for total assets and total liabilities. Once we have these two figures, we are able to calculate the shareholders' equity by taking the total assets minus the company's total liabilities. That is how we derive the shareholders' equity of a company. The next thing that we need to find out to calculate the return on equity is to find out the company's net income. And to find a company's net income, we have to take a look at the company's income statement. This is an example of a company's income statement. To find the net income of a company, we take the total revenue of a company minus the total operating expenses of the company and minus other interest income or interest expense. And then we'll derive at the net income of a company. Alright, now that we have found out the net income of a company and we have calculated the shareholders' equity of the company, we are able to calculate the return on equity for that company. So to calculate the return on equity ratio for the company, we take the net income of the company divided by its shareholders' equity. The net income of the company is 44,281, and then its shareholders' equity is 118,304. And if we calculate that, it will add up to 0.374 or 37.4%. And that is how we calculate the return on equity ratio for a company. Now, the next thing that you are probably thinking is, now that I know what is the return on equity and how to calculate the return on equity, the next thing on your mind is probably how to use the return on equity in the markets. And that is what I believe is the most important. It's nice knowing all the theory, but more importantly is, how do we use the theory in real life? And that is what we'll take a look at next. So in the third part of the video, we'll take a look at how to use the return on equity. Generally speaking, the higher the return on equity or ROE of a company, the better a company is able to generate returns on its assets. As a rule of thumb, we want to look at companies with a higher ROE, and the higher, the better. But a quick pointer to take note here is that you should not only focus on the return on equity. In fact, as an investor in the stock market, you do not only want to take a look at one specific financial ratio, such as the return on equity. Instead, you want to take a look at the broader picture. You might want to take a look at other financial ratios and perhaps the company's management and so on and so forth. The important point is this: we do not just want to solely look at one specific financial ratio, such as in this case, the return on equity only. But rather we want to take a look at the broader picture of things. But generally speaking, the higher the ROE of a company, the better it is. So how do we look for companies with high ROE? We do that by using screeners. The screener that I use is this website called Finviz. This is how the Finviz website look like. To screen for companies with high ROE, we want to use their screener function. And to use their screener function, we click on the screener tab. This will bring us to the screener page. And to screen for high ROE, we want to take a look at the fundamentals. And once we are on the fundamental page, we see that the return on equity is over here. But before we screen for ROE, let's take a look at the total companies available on the database. So as you can see over here, there are a total of 7,527 companies. And that is before we do our screening. It will take probably forever to go through each and every one of these companies. And that is why we want to use screeners to filter out companies that meet our criteria. In this case, we want to filter out companies that have a high ROE. And to do that, we click here. So you can see that there's positive, negative, very negative, and so on and so forth. Say we want to look for the highest of the high in terms of ROE. So we click on over 50%. Then the screener will do its job of filtering out companies that meet this criteria. So in this case, only companies with ROE higher than 50% will appear on our screen. And you'll see that only 202 companies out of over 7,000 companies meet this criteria. By looking for companies with ROE higher than 50%, we filter out a lot of companies. Some investors may think that an ROE of higher than 50% might be too stringent. In that case, you can change the filtering criteria. So you can choose maybe perhaps over 30% instead. So it really depends on the individual investor. On the one hand, you only want to take a look at companies with high ROE. But on the other, you don't want to set the criteria too stringent. If not, you might miss out on certain great companies. So as an individual investor, you need to find the right balance between the two. And that is how you can use the return on equity in the markets. To recap, in this video, you learn what is the return on equity, how to calculate the return on equity, and how to use the return on equity in the markets. Hopefully you guys have learned something from today's video. If you did and you are new to this channel, make sure you subscribe to this channel so that you don't miss out on future videos on investing, trading, and the stock market. I'll see you in the other videos to your financial success.